Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Foshan Haitian Flavouring and Food Company Limited Annual Report. Foshan Haitian Flavouring and Food Company Limited offers a diverse range of products and services that cater to the food industry. The company's primary business involves the production and sale of condiments, including soybean paste, soy sauce, flavored sauce, oyster sauce, vinegar, cooking wine, and compound seasonings. In addition to its product offerings, the company also provides packaging materials and glass bottles packaging services. This indicates that Foshan Haitian Flavouring and Food Company Limited is not only a manufacturer, but also a supplier of packaging solutions for the food industry. Furthermore, the company offers catering services, which suggests that it has expanded its operations to include food service provision. This diversification into different areas of the food industry enables the company to reach a wider customer base and increase its revenue streams. The company's products are exported worldwide, indicating its global presence and market reach. With over 65 years of experience in the industry, Foshan Haitian Flavouring and Food Company Limited has established itself as a reputable player in the food and beverage sector. Foshan Haitian Flavouring and Food Company Limited market capitalization of $266 billion is significantly larger than the average industry peer of roughly $3 billion. This shows that Foshan Haitian Flavouring and Food Company Limited holds a significant advantage in their industry. Foshan Haitian Flavouring and Food Company Limited trades at a higher price-to-earnings ratio of 26 times and a higher price-to-book ratio of 4.53 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 23% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 3.28%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth for Haitian International Holding Group Co., Limited can be attributed to several key factors. Firstly, the sales of flavoring products have been a significant contributor to revenue growth, indicating a strong demand for these products in various markets. Additionally, transportation services and interest income have also played a crucial role in driving revenue upwards. On the other hand, the primary drivers of revenue decline can be attributed to changes in contract liabilities. Specifically, the recognition of revenue during the year has led to a decrease in contract liabilities, resulting in a 4.1% decrease in revenue in 2023 compared to 2022. Furthermore, an increase in contract liabilities due to billing in advance of sales activities has also contributed to the decline in revenue. It is worth noting that currency-related risks pose a significant threat to the company's revenue growth. The exposure to foreign currencies such as USD, HKD, and RMB can have a substantial impact on the company's financial performance. However, the geographic distribution of revenue across various regions has been relatively stable, with no single region accounting for more than 10% of aggregate revenue. Overall, the drivers of revenue growth and decline are complex and multifaceted, influenced by a range of factors including sales, transportation services, interest income, government grants, and currency-related risks. Net income and profit margins. A shift in trends. The net income of a company has shown an upward trend, with a significant increase of 16.9% to RM 11,365.8 million. This growth can be attributed to the rise in profit before tax and a decrease in inventories. However, there is also a slight variation in net income figures, with another instance showing an increase of 10.9% to RMB 7,045.5 million. Profit margins have undergone changes as well. The gross profit margin has seen both increases and decreases. Initially, it rose by 3.3 percentage points to 39.4%. However, in a later period, it decreased to 15%, indicating a fluctuation in the company's pricing strategies or cost management. Furthermore, there was a decline from 30%, 34% in 2024 to 20%, 25% in 2025. The net profit margin has shown an increase of 0.8 percentage point to 24.4%. This improvement can be attributed to the company's ability to manage its costs and maintain profitability despite fluctuations in gross profit margins. Overall, these changes reflect the dynamic nature of a company's financial performance and the need for continuous monitoring and adaptation to stay competitive. The company has demonstrated a significant improvement in its operating cash flow over the past year. According to the financial statements, the company generated RMB 7,746 million in cash from operating activities, representing a substantial increase of RMB 6,840.2 million compared to the same period last year. This positive trend is a strong indication that the company's operations are generating sufficient cash to meet its financial obligations and invest in growth initiatives. The increase in operating cash flow suggests that the company's business model is efficient and effective, allowing it to generate more value from its core activities. Overall, this development bodes well for the company's future prospects and ability to sustain its growth trajectory. The company's debt level has experienced a significant increase from 2024 to 2025. The total debt level rose from RMB 10,199,512 in 2024 to RMB 20,925,379 in 2025, indicating a substantial growth of approximately RMB 10,725,867. This trend is also reflected in the restricted cash, which increased by plus 38.6% from RMB 8,393,000 to RMB 11,611,000. Furthermore, total liabilities also saw an increase from RMB 9,479,054 in 2024 to RMB 10,344,267 in 2025. In terms of interest expenses, there is a notable increase. The interest on bank loans and other borrowings rose by RMB 341, from RMB 21,819 to RMB 22,160, while total finance costs increased by RMB 1559, 6.5%, from 2024 to 2025. Additionally, interest expenses saw a growth of plus 1,242, from RMB 21,818 to RMB 23,060. These changes suggest that the company's debt level and interest expenses have both experienced significant increases over the past year. Management's outlook on the company's strategy is centered around technological innovation. They aim to provide full-scenario cooking solutions through internationalization and focus on promoting consumption with innovative products. The company plans to invest heavily in R&D and drive technological innovation, establishing a strong foundation for multi-category expansion. A key aspect of their strategy is the commitment to an annual dividend payout ratio of no less than 80% of net profit from 2025-2027. This indicates a focus on shareholder value and financial stability. Furthermore, management emphasizes the importance of investing in technological innovation capabilities and product innovation capabilities to tap into the immense growth potential of the condiments industry. The company's global presence is also highlighted, with subsidiaries in various jurisdictions subject to different tax rates. Management aims to achieve mutual growth of corporate performance and social value through partnerships, demonstrating a commitment to sustainability and community engagement. Overall, management's strategy prioritizes innovation, internationalization, and financial stability to drive long-term success. The company's financial activities have been marked by significant dividend payments. According to the provided summary, the company proposes to distribute a substantial amount of cash dividends totaling RMB 4,677,228,387 362.4 for the 2025 final dividend. This indicates that the company has a history of paying out dividends to its shareholders. Furthermore, it is mentioned that the company has paid dividends specifically to H-share shareholders, who are non-resident enterprise shareholders. This targeted approach suggests that the company is committed to rewarding its shareholders through regular dividend payments. In addition to dividend payments, there is also evidence of share buybacks by the company. Although not explicitly stated throughout most pages, it is noted on page 253 that the company has bought back shares through the overallotment option on July 16, 2025. This indicates that the company is actively managing its capital structure and shareholder equity. Overall, the company's financial activities demonstrate a focus on rewarding shareholders through dividend payments and strategic share buybacks. Concerns about inventory buildup and supply chain disruption have been raised in recent analyses. One potential issue is inventory buildup, particularly for specialty condiment products, which have seen a significant revenue growth of plus 14.6%. This rapid increase may lead to an accumulation of stock, potentially resulting in wasted resources. Another concern is the possibility of supply chain disruptions due to fluctuations in raw material prices. As these costs can be unpredictable and volatile, companies may struggle to maintain stable supply chains. Furthermore, existing data suggests that inventory levels have indeed increased, accompanied by a rise in write-downs of inventories. This trend indicates that companies are grappling with managing their stock effectively, which could lead to further disruptions if not addressed. That concludes the financial summary for Foshan Haitian Flavouring and Food Company Limited. Feel free to comment below, and I will be happy to answer them when possible.